Alright guys, welcome to this video. Here today we'll be talking about time frame interaction. Now a whole lot of traders make the mistake of analyzing a chart from all of the time frames available. So a trader would analyze from the monthly time frame to the weekly, the daily, all the way down to the 1 minute time frame. And that usually leads to analysis paralysis because you'll be seeing a lot of movement in the market. Ideally, you don't need more than three time frame max to analyze and enter your trade. Now, the time frame is determined by the sort of trader that you are. Before I continue, I am Jay Okoli and you're welcome to my YouTube channel. In this channel, we'll talk about everything related to the financial market and how you can be a profitable trader. If you're just joining us for the first time, do well to like, subscribe to this channel so you'll be the first to be notified when we upload new videos. And of course, you're going to be glad you did. So let's continue. There are different kinds of traders. You can be a position trader, a swing trader, a day trader, a scalper, depending on your style. Now, like I earlier said, you don't need more than three time frame max to analyze completely and trade the financial market. So if you are a position trader, that means you want to hold trade for a couple of weeks to days to months as it were. You can analyze firstly from the monthly time frame to get your general market direction, then you deduce to the daily time frame to mark out some key zones, and then you can take your entries from the H4 or the H1 and you are good. Sometimes you can analyze from the monthly and take your entry from the daily. It's not one size fits all. So minimum of 2, maximum of 3 time frame and you are good. This is for position trader. For a swinger who wants to hold trade for a couple of days into weeks as well, the first one can hold trade for months, the next can hold trade for weeks, right? For a swinger, your first time frame you want to look to get your market overview would be the weekly time frame, and then you get your key zones from the 4-hour time frame, and then you can enter your trade from the M30 to reduce the stop loss or reduce the risk. Now you can also analyze or get a general market overview from the weekly and pull the trigger from the H4 time frame. That works perfectly as well. So you see, it's just 3 time frame max, 2 minimum. Do you understand? Then if you are a day trader, right, you can analyze the chart from the daily time frame, and then you can get your key zone from the 1-hour time frame, and then you can also enter the trade from the M15 or M5, right? You can also analyze from the daily and enter your trade from the 1-hour time frame. This also works. You don't have to go through from the weekly to the daily to the monthly. Now this might sound simple, but a lot of traders keep making this same mistake over and over, and then they wonder why they are not profitable. Then finally, if you are not finally, okay, if you are a scalper or you want to scalp, you want to get quick opportunity, and this also works side by side with the day trader, which I'm going to stay with for this video, is you analyze from the 4-hour time frame to get your general market direction, your 4-hour time frame, and then you break down to your M15 to take your entry. You can also break down to M5 or M1 to get a very tight entry or exit. All right, so from the position trader to the scalper, you have your time frame. Your job is to look at what works best for you and stick to that, because we are all different as traders. Now we will just do a quick example from the scalper's perspective, the 4-hour time frame, and putting together all what we learned in the previous 3 videos. By the way, if you haven't watched any of those about how the market trades from one level of liquidity to another level of liquidity, I'll leave a link somewhere in this video so you can go watch those videos, and it will help you get a holistic understanding of this market. So let's look at the 4-hour time frame for GBP USD for this case study and break down this trade. By the way, we took this trade live after having a general class this morning in our WhatsApp community. So I'll probably leave a screenshot showing how this trade was taken, but let's analyze very quickly. So first of all, When you open the chart in any of the time frame you intend to trade, the first thing you want to do is to have a sense of direction, especially from the higher time frame. What is the market direction with respect to structure, with respect to liquidity? And then if you get the market direction, the next thing you want to look at for is how can you, or how will you participate, how will you buy if the market is bullish, or sell if the market is bearish. Now, very quickly, you can see obviously that for this particular asset, GBP USD, we came from a bearish drop, pulled back, and did this movement, and the price went up and did something we have talked about again in this channel. And what does that look like? It's a trend line liquidity sweep. So let me go over it again more slowly. You can see from this end that we had price, we're expecting as it were a trend line right here, and then price pulled back and went lower, broke structure, and then gyrated for several days and weeks all the way to this high. And we have explained that trend line structure or trend line liquidity is very beautiful to observe in chart. And how does that work? Just for completeness sake of this video, if you're in a downtrend and price wants to give you that, it will do little movement that has to respect trend line. That way you can easily draw a trend line and expect that if the downtrend have to continue, price will rally up to take out the very high that started the trend line. So you want to see price rally to take that high and then continue to the downside. Of course, if it's a bullish market scenario, price will do this sort of trend line movement. It will be moving side by side in small pushes, forming a trend line. And should price wants to continue being bullish, what it will do, it will break down lower to take out all of this liquidity resting right there and continue expanding. All right, so that is exactly what we see price did there. And while this was panning out, we did mention that's the reason you have that blue line resting there. So that area was a trend line, more liquidity that price rallied to take out right there. And then we had price did that. Now, something else is very important to take note of is that once price did that, it pulled all the way down to take out this liquidity, which we have called structural liquidity. In our earliest video, we are going to have more explanation with respect to the nomenclature on how to trade liquidity in this channel. And in case you want to follow on those patterns, please do it to once again subscribe so you will get to be notified firsthand once we drop that video on liquidity nomenclature. Now we see what price did right here. It took out that trend line liquidity and rallied all the way down to take out that liquidity at the downside. Now this movement left above it what we known as fair value gap. Now notice what price did. It came down this way, broke lower, respected some sort of movement, and once it took out this low, the next objective is to take out a buy side liquidity. So the ideology is that price is bearish, it just took out a downside or a sell side liquidity. Next, it want to seek to take out liquidity to the upside. So it is from liquidity to liquidity. Now earlier today, I already analyzed that we were going to have this liquidity at the top raided. We're going to have this area raided. Now the reason is simple, because this downside has been taken and there's a fair value gap above. So we want to see price come right there, fill it up and drop. I don't know when you're watching this video, but today is 23rd of October. You might want to look out for these movements that I have shared right here, in respect of what year you are viewing this video. Time and price or price action is fractional. So this 23rd of October, you can actually reference 2023. You can actually refer back to that date and see how this eventually panned out. Now obviously we did take out this buy, and how did we participate? Okay, now remember what we are doing. The first thing first, get your general overview from the higher time frame, and then you go to a lower time frame and pull the trigger. So I have done from the 4 hour, and the first thing I noticed prior to all of this movement was that price was here. It has done this push to the upside, It has done this push to the upside right here, pulled back, did this. I expected something to happen here and buy, and that gave at least 80 pips movement by the time we did take that trade. So let's wrap this up by going to a lower time frame. In this case, a 15 minutes time frame. 15 minutes time frame. Remember the rule, the 4-hour time frame, and then you go to 15 minutes time frame to pull the trade. Now we had two beautiful trading opportunity right here, although I participated in the second one. The first opportunity, by the way, this is where the new day started. So all of this price action to the right is the current day of trading, the 23rd day. Right now, the first trading opportunity we had is one of the video we taught right on in this channel. How if you are bullish, you want to see price do something like this to the upside, and if it's very clean, expect price to come back to take that low and expand higher. That is scenario one, or a very beautiful entry. Then the second entry model is you have price do this and that, and then you expect that second leg to fail that way to the upside. All of these videos are in our YouTube channel. You can check out on our videos where we did mention all of those stuffs. So let's put this line to demarcate the new day, right? To demarcate the new day, something around that area, and I'm going to zoom in so you can see what we're talking about. So look carefully to what price did right here very quickly. You can see this push all the way to the upside, and of course it broke structure to the left. What did price do? Price came back, took out the very low that started that push, and then what do we see? It did this, came back to induce traders that they are going to sell, and then boom, to the upside. All right, this is a work of art. If you can memorize patterns like this, more important than the pattern is the ideology behind the trade. First things first, you have known the direction market should go. The next thing, do not counter trend. The easiest way to get blown out of the market is to counter trend. You don't want to go against the prevailing trend you have seen from the higher time frame. You must respect the trend, else you're going to get blown away. You're going to get fried out. So we see price did all of this movement to the upside, and then it left liquidity right here at the low right here, and that was the first example to enter the trade. Like again, I said I did not participate in this first entry, so that would have been, or that was the first entry, price taking out that low, and then you can easily put your stop loss just some pips below that, and then expect price to expand to the upside. Okay, especially to that area of liquidity we expect price to get to. Now the second entry, which I yours truly participated in, and by the way, I'll leave a screenshot already of this trade. I'll leave a screenshot of that. So let me take this to the side. Right, that was the first entry. The second entry was this, very beautiful. All right, so notice what I'm going to do right here. We've done this over and over again. Notice that low becomes a very strong low. We don't want to see price take out that low again. It's very strong already because that swept liquidity to the left. Now look at that high that price broke on its way going up. However, on its way going to break that high, it created a low right here, right there. Right, this was the only low it created before it took out that high. So what we had was price has swept something down here, then it was going to take out that high up there. It went up, created a low, and took it out. So what do you expect that high to fail? That is your buy entry, and boom, to the upside. Very simple, very simple. And that's what we see price did right here. If I go to 5 minutes, you will see this was a very nice low at the 5 minutes time frame. So I was putting my buy limit right there, right, and price got me filled in, and boom, right. While the rest of traders who are ill-informed are seeing all of these things as a sales setup, but we know where we are going to. Why? Because the higher narrow time frame already told us we are bullish to a level. Now, at the time of recording, the yellow line up there already shows us the hourly or the 4-hour fair value gap, which we expect price to most likely fill and start doing a decline. So I have bought, made money, made profit. I expect to sell along the line. All right, so we are going to stop right here. If you have questions to ask, please do well to post in the comment section. I'll be here to respond to them. And I'll leave a link to our general Telegram channel right on in this group or in the description, so you can join our general Telegram channel. We do have classes sometimes in the morning before London session, so we have practical trade session for you. All right, if this video has been a help or you've understood so far what I talked about in this video, please do well to leave a like, a comment, and I hate to be the guy to say subscribe, but please, is a way to help the algorithm so more people, more traders will learn what you are learning. All right, I'll see you in the next video. Jay Okoli signing out. Peace out.